So what we just ended up seeing was rates over the last 2 weeks roughly have come back down to 7%. They dropped briefly below 7%. And now what you see is rates push loan application volume back up to March levels. So that slowdown that naturally would have happened, rates have started to come back down again. And we're probably going to bounce around here, but it's increased mortgage loan applications. Well, what does that mean? That means more people are considering buying and getting into the market if they're doing loan applications to see what they can qualify for. So all this, the interest rate movement is going to dictate the volume in the market and where prices are going to go. And we're restricted on supply right now because what you just said, everybody refinanced into a 2.5% to 3% mortgage, and they got such a low rate, low monthly cost that it's locked them in place. We don't have the inventory on the market. We have a little over 600 homes actively available for sale on Oahu right now. Well, in 2006, 2007, when we had 25% price appreciation, when you could get a loan without having a job just for basically being able to breathe, right. We only had 814 homes on the market. So we have less homes on the market now than a really hot market. And in 2019, our lowest month of active homes was 1,641. So our what you can buy is so restricted that when rates go down, you increase the demand and you have restricted supply. Guess what's going to happen to prices?
Yeah, absolutely. They're going to go up.
Yeah,
nobody needed me to answer that. I mean, that's what happened. So, but I will. Back when they basically would give you a loan for not even being, just basically being able to breathe and have a pulse, I couldn't even qualify for that back then. I don't know what my problem is. Anyways,
I'll never forget the loan program that I knew a couple of people that got into. They were called negative amortization loans. The only people that normally use negative amortization loans would be developers. So basically how it works is you get a loan, you have an interest payment portion and a principal payment portion, and you can pay a minimum amount. You don't even have to pay the full principal or the full interest payment. You pay a minimum amount, and the rest of what you should have paid goes back into the loan balance, increasing your loan balance, and it recalculates the next month. And why developers use this? Because they want a low carrying cost to reposition that property however they need it. They're in it for a short term, and they're trying to make a profit out of the back end. So you want your carrying costs as low as possible. You don't buy that. You don't use that loan when you're trying to buy a home that you're going to live in for the next 5 years. People were doing that because prices were appreciating at 20% a year. And they're like, I'll just make the monthly minimum because my home's going to be worth so much more next year. And then the bottom fell out. And some of those people got caught. Those were people that ended up foreclosing.
Some of them, a lot of them did, foreclosing or loan modifications, whatever it was, if they wanted to keep that house. That was definitely... Yeah. Now, here's the thing. Recently, I've heard some indications that the zero down mortgage may be reappearing, but let's not go into that. Okay. That's a rabbit hole that, we'll go down some other time.